And for our webinar account, what we're looking at here on the PowerOptions suite of tools is a essential trial account, a 14-day free trial, which you'd get if you just went to powerop.com, put in your name and email address, and no credit card required to start your trial for 14 days. PowerOptions is designed by a tab navigation system. You start off with lock tabs for the main home tab to access things such as our free webinars, free coaching sessions scheduled there, Learning Center, blog, and other things. My Portfolio, where we track our positions, can see closed positions, analysis by symbol and position when we're rolling and adjusting positions, and more. And signature tools, such things as the volatility skew, market sentiment, spread chain, long option finder, stock repair tool, stock insurance tool, and the strike of pain tool as well. And then we get into our strategies. We have several lists of strategies here. As I mentioned, we support over 23 of the most commonly used strategies. Let's see a strategy you want right away. Simply click the Other Strategies tab, and you'll be able to customize it from the available strategies here on the left to add to your available tabs here on the right. Well, I'm just going to go back to default strategies here, which I think I had, by the way, but we're just going to go back to the default ones, and let's go ahead and go back to the main home page. Now, underneath the strategy tab, of course, is where you can access the tools. So I click on the strategy tab or hover over it. And for naked puts, you see here for covered calls, we can go to the main home page, which will show us some information, Learning Center, and more. But we've got quick links to the monthly picks of the day, the weekly picks of the day, of course, the option chain tool, search tool for searching across the universe of options, either using our default criteria or customizing your own, sample searches, other themed searches related to dividend stocks and in the money, dividend stocks and out of the money, and so forth. And, search by symbol, looking up covered call opportunities or other strategy opportunities one stock at a time. And of course, if during the trial, you also have access to the historical search and the historical search by symbol and the historical option chain, which goes back about 3 months in time. For covered calls, naked puts, bull put credits, and long calls, actually, you'll see these picks of the day selections. And the picks of the day selections here are, you see usually the top 2 or the top 3. They're updated once per day with the top trades that match a default criteria set. Also, to make things easier, we recently added one of a pod to the main home tab where you can set up your watch list, of course, and create stocks that you're tracking or following, the market sentiment tool based on the 13 broad-based indicators, general market activity, next live webinars that are available. But we added the trade picks, which shows you a quick view of the covered call trades, monthly and weekly picks of the day, the naked put, monthly and weekly picks of the day, bull put credit, and of course the long call as well, the weekly and monthly expiration also based on Ernie's preferred criteria. Now, I'm going to go back to covered calls real quick, but we're going to go back up to the top. That's just a pod to help make things a little bit easier for you to see results very quickly. But as I mentioned, I could just go right to the covered call tab, and I could go to the monthly or the weekly picks of the day. As I mentioned, this is a quick view. It's updated once per day based on the time frame that Ernie would have likely entered these trades when he was doing his initial testing, initial paper trading, and actual trading to develop the criteria. Now, this is a more simplistic view than you see in the search tool. We'll take a look at that in a little moment as well. But what do we see here with this particular view? Well, we see the first one, ELF Beauty, ELF, just found out the other day. It stands for eyes, lips, and face. That's why the bullet points are there, but that's ELF Beauty. Currently trading at 155.13. Well, at 1 p.m. Eastern time, when the API updated the picks of the day results for the quick view, that's where ELF was trading. It was down about $1.25 at the time. And we're shown for next week, we can sell the 26th of January expiration, 150 strike, bid of 720, ask of 770. So maybe a midpoint of 740, maybe 745 if we're lucky, but somewhere in that range. And the midpoint price would give us, for 7 days, remember, a 1.6% return if assigned if the stock's above 150 with a 4.8% downside protection, meaning the stock could drop 4.8% from that price of 155.13 down to 147.68 before we're technically losing money on the position. And as you see, the midpoint time, I said the time value is 232, but the midpoint would be about 745 or so, but we are $5.13 in the money. So part of that 720 is the $5.13. The remaining 232 at midpoint would be the time value return, which gives us that level. Now, why I'm bringing this up is Kenneth had asked a question prior to the webinar via email, and he wanted to know, why are the weekly or monthly picks of the day showing in the money covered calls? Well, down here you have a little description of how to enter the trade, placing a midpoint order, the top stocks with the highest returns based on the criteria selected. But, oh, sorry, folks, but then there's that other link there. See how we develop these results. And I think you've seen this before, Kenneth. I'm not going to read it, of course, but we're just going to go through it. What Ernie did for each of the picks of the day, monthly and weekly for the covered call and for the naked put, of course, is write up essentially what he did. How did this come into play? Well, essentially, Ernie was challenged years ago by a new customer of PowerOptions during a coaching session. And he said, well, what criteria should I use to trade covered calls? And Ernie took him to the search, and they went through the default criteria for in the money, at the money, and out of the money that we have, because there's 3 different ways you can trade a covered call position. And that essentially would be our starting point based on what we were considering. If I just want to get premium, don't mind being assigned, I'm not looking to hold stock long term, but I'm looking to target a 0.8 to 1.4% return per week with a high probability of earning that return and getting assigned with a good downside protection, or monthly, maybe go out 2.5, 3% possibly, with having an 8 or 9% downside protection, more comfort, more conservative. That's an in the money covered call. If I want to hold the stock long term, I'm looking to hold the stock, generate weekly or monthly income, but hold the stock and also take the dividend. I'm expecting more growth. I'm probably trading out of the money covered calls. I'm selling calls above the current stock price for either more appreciation or to not be assigned and just collect an extra dividend-like income on a consistent basis. At the money, yeah, a mix of the two. Good downside protection, highest time value at the time, good percent return if assigned as well. But this goes through what Ernie did. The customer then said, well, no, just tell me what criteria you would use to enter trades. If you, Ernie's a renter, created PowerOptions in 97, have been trading options since the late 70s, early 80s, what would you do right now for the best overall return, different market conditions, whether you're opening a trade now, opening a trade 2 years from now, 5 years from now, in different market conditions? So what Ernie essentially did, Kenneth, is he went out and did about 70, 75, or 80 different iterations of covered call criteria for the weekly series and for the monthly series, using the vast array of technicals and fundamentals that we can use in the covered call screen. Naturally, days to expiration, but time values, implied volatility, focusing on highest percent if assigned, what type of downside protection, range in or out of the money, minimum bid price, limiting the bid-ask spread, open interest. Was delta a factor? Was the percent to double a factor? The Black-Scholes ratio, searching for overvalued or undervalued options. What about technicals? What about beta? Do you get better results if you limit beta to be less than 1.5? Or if you put it greater than 0.75? Or if you put it between 0.75 and 1.25? Is it better to trade the positions where the stock is near the high of its 52-week range, or is hit that and has fallen down to the bottom? By the way, bottom feeding doesn't work in the covered call or bullish strategies. We've done that sort of bottom feeding, looking for stocks that are in the lower 10 or 15% of their 52-week range for covered calls, naked puts, bull put credits, bull call debits. They never work out. Those ones that are down there usually still continue to keep falling. But in any case, sometimes they do hit a floor and rebound up, and we take advantage of that for other strategies. Is volume a factor? Average broker recommendation? Bollinger Band ranges, simple moving average, MACD. What about the fundamentals? What are some things good to use for? Do I want to use a specific stock price range? Do I want to look for specific earnings per share growth, price to earnings, market cap? Does it matter if I do or do not avoid earnings between now and expiration? Is it better to use dividend-paying stocks or not use dividend-paying stocks? What about our stock list, our preferred stock list? Is there a specific list that worked better over time with other criteria and ones that worked worse? And running those different ones and going through the different iterations over the time period, the testing time period, my apologies, Kenneth, the results of the monthly and weekly picks of the day criteria are, sorry about that, let me just navigate over the weekly picks of the day, so you can see it real quick. The results of that testing period using lower implied volatility of less than 1, minimum 0.7% if unchanged, at least 1% in the money, at least a 65% probability assigned or higher. Earnings, of course, not between now and expiration, stock price just greater than 10. Positive MACD crossover by at least 1 day, 500,000 average shares per day, and a stock price greater than the SMA 20, as well as, avoiding indexes and ETFs to look for that better return. That's what came out the best. But also, let's go back here to the weekly picks of the day and that view I was talking about, see how we developed these results. The time frame he did, and we've done other tests during the years for different discussions that have come up during the presentation. How did this do in the last 5 months? How did this do in the last 6 months? How did this do in 2021? We usually go back and do that from time to time. That's available somewhere on YouTube. I have to find the specific links, and we'll do another one. Now that we're in 2024, we're going to look back at the picks of the day for 2023. But this time period that's selected is just about a 1-year time period from 2015 to 2016. Ernie selected this because good mid-range, which would work great for covered calls and naked puts, significant downturn, reasonable movement up, good 3 or 4 months uptrend, and then some stability, another decline, and then another increase. Differing market conditions. Not a stable lower left to upper right, because the market doesn't always do that. The market doesn't always do a upper right to lower left either. You're going to have a mixed bag from time to time. Yeah, some years we had that melt up year like 2021, where we went ahead and we saw what? In 2021, we saw, a month or 6 to 8 weeks of a good 3 to 4% rise, then a 1 or 2% fall. And then another one of a 4 or 5% rise, then a 1 or 2 fall. And this is the perfect kind of market. We call it the melt-up market. Covered calls, naked puts, bull put credit spreads, possibly even iron condors if you don't have a good sudden run. Now, 2022, we know was all over the place. So was 2020, but volatility was good, so the premiums helped, but the market was a lot more like this, wasn't it? And then in 2023, we had a couple of dips there early on, I think February to March, and then again later in August. And then we had that rapid increase at the end of November into December, which gave most of the bulls a very, very good end to the year situation. And we've seen some continuance of that with some hesitation going forward. So why are they in the money? It's because with the preferred criteria that seem to work best with underlying stock performance and options performance, the in-the-money ones met the goals the best for the positive return success rate. 77% of the trades were successful out of 104, 52 weeks, only taking the top 2 trades. Average return was 2.3%, and average loss was 3.2%. And so it made a 24% return over the course of the year, which is essentially what you look for in the covered calls. Around 1.5 to 2.5% return is a reasonable expectation for covered call positions. We look at certain years. I could go back, and I was going to do this, Kenneth, and I did some of it, but I didn't get a chance to do both. I could look back and say, you know what? If I took that same criteria for the covered call, Kenneth, the weekly picks of the day, and change the range in the money to be greater than 1%, to be 0 to 3%, And I'd have to adjust the probability as well, because I wouldn't see the 65% probability if the stock was out of the money. I'm sorry, the call was out of the money. My apologies. We'd see a much lower probability, 25, 35, maybe 40% range. So I take that out. But if you did the out of the money screen with the same stock criteria, and then, for example, you just looked at the last month and a half and said, oh, the out of money covered calls would have done better, considering that SPY had that large shoot up. So any stock positions, you would have gotten a better return with the out of the money covered call position, because you would have seen what? You would have had both appreciation to the call strike price and a small premium, getting assigned week by week, but making an extra 2-3% as the stock moves up. But remember, the out of the money call, especially on a weekly, is only giving you 4, 5, or 10 cents. So you look back over the year, and how would out of the money weekly covered calls have performed as a hedge on your positions? Here, here, here. You don't have as much protection. You're giving up more. Yes, you're getting assigned here for the higher return, but you're taking much larger losses here and here and here. And that's exactly what Ernie saw. Over time, with the same successful criteria for underlying security, where you see the stocks move up consistently, either month by month, some stocks are going to fall out, others are going to come in. But if you run that with an out of the money covered call, an at the money covered call, and an in the money covered call, you're going to see a higher success rate, and in most examples, almost every example we've run, a higher return rate with the slightly in the money covered calls. You're not married to the stock. You're not looking to hold the security for longer term growth. The weekly picks of the day and monthly picks of the day are designed to, I don't want to be invested long term in the stock. I want to see which covered calls can offer me a good downside protection, a good percent return if assigned, and give me 75, 77, 80% success rate where I don't have to worry about closing, rolling, or adjusting the position. I just want to be assigned, make the return that were my targets, and then look for new positions the following Monday after expiration. That's why the in the monies are chosen, because they were the ones that did perform best over different market conditions during the testing cycle, trading cycle, and the back testing cycle as well. And of course, you can see that. Let's just take ELF since we were talking about earlier. So the new one, this is the weekly picks. Oh, I'm sorry. Let me go back to the weekly picks of the day here. This was the one that was most updated. The close ELF still in there, but the stock's at 157.79. We're seeing actually the 152.50 for almost that same 730, 735 price. We saw the 154 at 1 p.m. today. So it's still that 4.6, 4.8% downside protection with a 1.3% return if assigned and a 65.4% probability of getting assigned and earning that return. But if I just go straight to the option chain just for next week, you can see specifically what I'm referring to. I had mentioned the chain when we talked about the covered call and the various tabs. One of the reasons why the option chain, we like to use it specifically for covered calls traders and for cash secured or naked put traders when you look at the put chain, is we include the important columns for return if you were to trade this as a covered call. The downside protection, the option premium, midpoint divided by the underlying stock price, how far the stock can drop percentage-wise before you're technically losing money on the position. The percent if assigned, which in this case is equal to the percent if unchanged. If the stock doesn't move, you'd still be assigned. If the stock's above 152.50, and you'd make 1.3% return in 7 days. These are the values that are shown. Of course, the percent naked yield is if you did this as a naked call without owning the stock. Don't highly recommend that, but you'd see that for the puts as well. And you can add other columns. I have the probability, as I mentioned, in the money, and the midpoint time value. But right here, Kenneth, you can see the comparison. I'm getting $7.30 at midpoint for in the money 152.50, which gives me a 65.4% probability. 1.3% time value, which is my potential return, and I have a 4.6% downside protection. The next 7 days, the stock can drop almost 5% from technically losing money on the position. I'm at break even. Stock's at 157.79. The at the money would be the 157.50. That's the closest. Higher time value, $4.30 instead of that $2.25 or $2.30 or so that we'd have with the in the money. Remember, because most of that is intrinsic value. This gives me a 2.7% downside protection, still really good, and a potential for a 2.6% return if assigned, double what I'd get with an in the money. But I only have a 50.9% chance of getting assigned and earning that 2.6% return. 2 strikes out of the money, looking for that appreciation. I feel confident in ELF. I think it's going to continue to move up. I'm going to sell the 162.50 and get 228. Roughly the same time premium that we're seeing with the in the money option. But that's all we're getting. So what do we have here? Only a 1.4% downside protection before we get to break even, with a potential 4.5% return if assigned. If the stock is trading above 162.50, we get that extra 5 points almost, $4.70 of appreciation to 162.50 plus the 228, but there's only a 36.6% chance that I'm going to make that max return in the next 7 days. What do you see here? The in the money and the out of the money, the reasonable in the money, I should say, and the reasonable out of the money. Even the 150 is reasonable with a 1% return and almost a 6% downside protection. But those 2 strikes I just looked at, the 152.50, almost a 5% downside protection, still an opportunity to make 1.3% in the next 7 days, and a 65% probability of earning that return. Versus the speculative, more bullish, out of the money, which only has a 1.4% downside protection, but the potential to make 4.5%, only a 36% chance of getting that 4.5%. What do we see? These are reversed. Higher potential return with a lower probability of realizing it, but not as much downside protection. In volatile markets or shifting markets, I'm probably going to see losses more quickly with the out of the money approach. Even though it has the potential for a higher return, it's a lower chance of getting it. Stand a higher chance of maybe getting that loss or hitting that break even with just the stock falling 1.4%. Meanwhile, I can get a 65 or 70% chance to make 1 or 1.3% with having a 4.5 to almost 6% downside protection using the in the money options. And again, I'm not married to ELF. I'm looking just to make that return for the 5 to 7 days, get assigned, make my 1%, 0.8%, 0.7%, and then on Monday, the following Monday after that expiration, look for the new positions in the picks of the days that match my expectations. Might not just take the top 3 from the quick view. I'd probably use the search, look at those other positions that are there with more updated times, see which ones I like, and then enter the trades. But that's why we're using the in the money positions. Is there anything wrong with out of the money covered calls? No, I'm not saying that. Okay. Again, earlier I mentioned if I want to hold a stock long term and collect the dividends, for example, or I believe it's a bullish stock, I've owned it for years. I've owned ELF for years, and actually I have a cost basis of $65, and it's in a cash account, so I don't want to be assigned to deal with a tax penalty in 2023 or 2024. I might be selling out of the money calls. But you know me too, Kenneth. If I have a stock that I'm bullish on, or I want to hold for 4, 5, 6 to 8 months, I'm using it as the married put as described in the blueprint, as opposed to an out of the money covered call position. I'll still sell calls against that married put structure and do other nested spread trades using the 12 income methods discussed in the blueprint. But that's protection in place for a longer term holding. But I have many power options users that do this. They have stocks that they've owned for years. They have a very low cost basis. Some are in sheltered accounts, some are in cash accounts. And they're just continuing to collect dividends, and they're just selling a cheap out-of-the-money call, probably with lower than a 30% probability. Oh, sorry, folks, where they're only getting maybe 1% a time premium for a week, maybe 2%, 1.5% time premium for a monthly just to get an extra dividend-like income. They don't want to be assigned on the position. The covered call approach, the picks of the day approach, I should say, Kenneth, are more designed to just find trades that match the criteria, go with a good probability, and have the stock trends that we have shown work for that strategy consistently for the targets of the covered call strategy. And that's why they're in the money. That was the best result Ernie had with the structures that worked as well. In the money, covered calls are more conservative, as you can see, higher probability, higher downside protection, lower return. Definition of more conservative. At the money is moderate. It's still a powerful percent return for a 7-day trade. It's still a reasonable downside protection. You got a 50-50 shot of getting the max return. Or, just having the call maybe expire, but still being in the profit zone if it hasn't fallen more than 2.7%. It's a valid approach to covered call trading, I should say, as well, Kenneth, based on your risk tolerance, based on your expectations going forward. Is there anything wrong with out of the monies? Not necessarily, but it is considered more speculative. Higher potential return with less protection and a lower chance of making that return. By definition, that's speculative. By just those 3 quadrants, that's going to be a speculative trade. But again, it has its place for positions you want to hold long term, don't want to be assigned, want to stay out of the money, still want to generate a dividend-like income on a monthly, or maybe doing week by week. But as soon as you start getting further out of the money to those lower deltas and lower probabilities, you're also seeing premiums of 20 cents, 30 cents, 40, 50 cents here on a higher price stock as well. So is it worth it? Well, it's 30 to 40 cents you didn't have the other day. But again, where's the best bang for your buck? That's usually within this, 2 or 3 strikes out of the money, if that's your approach, in my opinion. Like I said, the probability around 30%, a delta of around maybe 0.3 to 0.2, still giving you a good premium of around 1%. This is for the weekly, by the way. And ELF's a little bit more volatile than some other securities. But again, that's why the picks of the day for the covered call are in the money. Of course, that's why, naked puts are out of the money too, because I don't want to sell an in the money naked put. I don't mind getting assigned, but the goal is I want to be assigned at a lower price if I'm looking to buy the stock. So yeah, I want to be out of the money. If the stock falls to my target price, hey, I got paid a premium to buy the stock at the price I wanted when 15 days ago it was trading at a higher value. So use out of the money naked puts, which are essentially a parity trade, to an in the money covered call position as well. Now, I hope that answers your question. And remember, of course, you can see the static view for the picks of the day, I should say, right here. But remember, these are mostly just updated once per day. If I'm going to see a more updated, it's 2:35, it's almost 3 o'clock Eastern time. I want to see a more updated search results or more updated prices. Just go to the search under covered call, under naked put, and select the default that you want to see, monthly or weekly picks of the day. And, ELF is still there, but it's not the top one anymore. We have Cassava Sciences in there and Kava Group as well. DraftKings in there. So you see some different positions with the different returns. And of course, as I mentioned, we can delve deeper in the stock chart, company information, research, and analysis and more. See which one best suits your goals for what you want to do. Maybe not necessarily just take the top 3, but like as I said, we have investors that do that. They come in around 1 o'clock Eastern time when this updates. They evaluate the top 3, but they'll open the top 2 or 3 from the monthly or weekly picks of the day, or do the monthly or weekly day naked put, or even potentially the bull put credit spread.